Good morning, ladies and gentlemen. On behalf of Capital Trust Research Private Limited, it gives me immense pleasure to welcome you to our research webinar on financial year 2023 earnings outlook of Expolanka Holdings PLC. A number of positive developments have taken place recently. SG Holdings purchased over 75 million shares of Expo up to LKR 235 per share, bringing the much needed foreign fund inflow of over rupees 17 billion to the stock market. This net foreign inflow has deleveraged the market to a large extent and has increased market liquidity. With inflation close to 70%, while fixed deposits and treasury bills being taxed up to 36% for individuals, the negative real return has increased to over 50% in those investments. We believe that these factors, combined with the current historically low valuations, will bring in more funds to the stock market. However, we also caution investors regarding the risk associated with the stock market, especially due to the abnormally high borrowing rates, which is reducing profitability of companies, increasing margin trading interest rates, and uncertainty regarding the country's debt restructuring process. Today's webinar is the 34th of a continuous series of webinars that Capital Trust Research Private Limited has been hosting. Capital Trust Holdings Limited and Capital Trust Properties Private Limited would like to make a disclosure that in the last 2 years and at present remain substantial shareholders of the stock being covered today, and hence investors should do their independent research before investing. Now we are pleased to introduce Mr. Hasitha Liyanage, Head of Research of Capital Trust Research Private Limited, and Mrs. Divya Kasi Chetty, Head of Corporate Finance of Capital Trust Partners Private Limited, who will make the presentations. They will be happy to answer those questions you may have at the end of the Q&A session. Over to you, Divya. Thank you very much.
Thanks, Prashani. We believe that it is the right time to provide an update on Expolanka, given the changes in the prevailing operating environment. As you are aware, Expolanka has consistently recorded strong performance over the last 2 years. The strategies adopted by the company provides a strong foundation for long-term growth and consistent performance, despite the changes in the global macro environment. Before we look at the numbers, let's take a few minutes and discuss strategies adopted by the management to support their future growth. Over the last few years, Expo focused on consolidating its operations and was successful in growing its key strategic customer base from 10 to over 60. This has resulted in a steady volume growth over the years. The strategic customer base is based on strong relationships, providing Expo a strong competitive advantage. The model is structured such that the business no longer goes through the seller, but rather the brand. Expo's growing presence in both origin and destination markets enables the company to offer end-to-end solutions to key strategic clients. This also eliminates the need for an intermediary, providing an opportunity for the company to control both sides of the transaction and thereby further enhance their revenue and profitability. Procurement is a key area of focus. The company has been successful in building the necessary capacity with air and ocean liners to serve the customer's demand. Further, the company uses an optimum mix of both spot and forward contracts to ensure profitability is enhanced. Efficient procurement strategies adopted provides an edge to Expo to win over the business by providing total logistics solutions across multiple geographies. This strategy will contribute in a steady volume growth over the years. The company has focused on organic expansion through investments in people, infrastructure, networks, and presence in key markets. The company has strengthened its network operations in key origin markets in Asia, such as Vietnam, Indonesia, China, and Cambodia, which are all key trading markets with the US, and set up new markets in places like Malaysia, Thailand, to take advantage of opportunities in the US and Europe. In addition to organic growth, the company is aggressively looking at mergers and acquisition opportunities to further enhance their service capabilities and offering. And thereby, in turn, they are able to offer total solutions to customers and to match their supply chain requirements. Acquisitions is a key long-term growth strategy going forward in order to build capabilities and infrastructure. The depressed market conditions provides Expo a unique opportunity to pursue this M&A strategy and acquire potential targets at attractive valuations. Given the slowdown in consumer demand due to rising inflation and possible global recession, cargo volumes have witnessed a decline. As such, a decline in volumes across the industry is expected in the second half of calendar year 22. Expo too will experience a decline, although will outperform the industry given the strategies adopted. Against this backdrop, revenue decline is expected, and as such, the need for working capital too has reduced. This, coupled with the steps taken by management to deleverage their balance sheet in a high interest rate environment, provides Expo an opportunity to gear up when required to finance acquisitions or CapEx for growth. In addition to these strategies, the company has also enhanced technological infrastructure, made digital improvements, and actively adopted technology to bring transparency to customers and achieve operational efficiencies across the logistics sector. Expo management has a long-term vision to consolidate their presence and steadily grow the business volumes. These strategies have been adopted taking a long-term view to sustain and enhance their performance. As mentioned previously, new client acquisition is a pillar of their success as it provides a platform to steadily grow volumes in the future. During the last 2 months, Expo has onboarded scalable customers through superior service offering. These customers will provide a foundation for steady growth once the market recovers. The company also focuses on growing and increasing their wallet share with key strategic customers and has been successful in retaining new customers onboarded over the last 18 months. The company has been successful in penetrating 5 to 15% of wallet share of their new strategic clients. This provides them a good opportunity to further increase volumes once consumer demand picks up and market recovers. In a similar manner, larger wallet shares with existing customers will also positively lead to higher volumes when industry cycle improves. Efficient procurement is integral to the success of the business. Generally, the revenue is split approximately 60% and 40% between air and ocean segments. However, the company has focused on developing its ocean product and increased customer penetration within the segment. As a result of this trend, the revenue in the first quarter was dominated by ocean freight, which contributed 62% to the top line. Ocean rates are generally less variable compared to air, and development of this segment will result in long-term sustainable earnings. The company is expected to continue to record strong and enhanced gross profit margins despite the rate decline through efficient procurement strategies using an optimum mix of spot and forward contract rates. The gross profit margins can be expected to improve across both segments, where air freight is expected to improve from 11% to approximately 12 to 13%, and ocean freight from 16% to approximately 18%. Despite the gross profit margin improvement, operating margins may witness a decline due to the expected drop in revenues as volume contraction is faced across the industry. As mentioned before, mergers and acquisitions is an important growth strategy for the company, and they are continuously looking at potential opportunities. As done in the recent past, the company will aggressively focus on acquisition-led expansion to grow their portfolio and service offering. Given the operational challenges faced by the industry and the reduction in profitability of potential target companies, valuation multiples of potential targets are low, thereby providing a good opportunity for Expo to carry out potential acquisitions at attractive valuations. The company is taking advantage of the current operating environment to deleverage their balance sheet. As volumes decline, the associated working capital requirement is also less. The company has used excess cash available to settle debt, which is a prudent measure against the backdrop of rising interest rates. Deleveraging their balance sheet provides an opportunity for the company to invest in high return investment opportunities in the future. The company's dividend payout policy of 22% enables the company to retain 78% of earnings within the business, providing them the ability to fund future acquisitions through built-up reserves. These measures have been implemented today in order to gear up for future growth. Now that we have a better understanding of the key strategies adopted by the management, let's move on to discuss the macro environment. As you know, 84% of Expo's revenue comes from the North America trade lane. As such, US is an important market for the company. Therefore, it is important for us to understand the market dynamics in the US. Draw your attention to the graph on the slide, which depicts the US import volumes. Although in the first half of the year, volumes increased year on year, the volumes are expected to decline during the second half of the calendar year. Many retailers bought in merchandise early this year to beat rising inflation and ongoing supply chain disruption. Although consumers continue to spend, there is a falling demand for merchandise from retailers as they have sufficient inventory at the moment. US consumer willingness to spend overcame inflation, with retail sales up 0.3% from July and 9.1% year-on-year in August 2022. Despite this, the consumer spending is expected to be moderate over the next few months, given the rising inflation, higher interest rates, and expectation of a global recessionary environment. Let's take a quick look at what's happening with the freight rates. As mentioned before, a slowdown in consumption is experienced given the rising inflation, surging energy prices, and increase in global interest rates. As such, an increase in inventory is witnessed across global retailers, which has resulted in a slowdown in demand for freight. This has caused the freight rates to decline. This trend is witnessed across major trade lanes, with demand softening. According to industry experts, pandemic-led increase in freight rates have peaked, and it is likely that the current rates may continue until global interest rates start easing, possibly in calendar year 2023. Industry experts also say that they don't expect freight rates to return to pre-pandemic levels, in part because of the higher fuel cost. The graph on this slide depicts the ocean rates for China East Asia to US West and US East Coast. As shown, the rates across both routes have declined, with ocean rates for Asia to US West Coast being the lowest since 2020. Although Asia to US East Coast rates have declined, it is declining at a slower pace given the prevailing port congestion. Air freights too have witnessed a reduction as market adjusts to less volumes and more capacity. The global air cargo market is facing mixed outlook, with high fuel prices helping to support freight rates, which remain significantly above the pre-pandemic level. Despite this, demand growth is likely to flatten. The graph represents the air freight rates from Asia to America. The rates have declined with a certain level of volatility experienced in the air cargo segment. However, rates are expected to remain above pre-pandemic levels. Despite the challenging operating environment, Expo is expected to remain resilient and adopt long-term growth strategies by acquiring new clients, deepening wallet share, deleveraging their balance sheet to gear up for future growth. Expo is forecasted to increase gross profit margins, even in a declining rate environment, by using efficient yield management strategies. The company has been successful in managing procurement by using the optimum mix of spot and forward rates. Furthermore, implementation of customer-centric strategies also contribute to margin enhancement. As discussed earlier, cargo volumes imported to the US in the second half are expected to decline compared to the first half. Inventory buildup is witnessed as retailers and cargo owners shipped holiday goods earlier and given the suppressed consumer spending. As a result, we expect the surge in demand experienced by the industry each year between August to November to ease in 2022. Against the backdrop of suppressed consumer demand and possible recession, it is likely that along with the industry, Expo too will witness a volume decline. Despite this, it is forecasted that Expo will beat the market by over 30% by onboarding new strategic clients and increasing wallet share of existing clients. A pickup in demand may be experienced towards the end of December 2022, with retailers placing new orders to replenish declining inventory levels post-holiday season. I will now hand over to Hasta to discuss the financial forecast and valuation. We will be back in 2 minutes.
Thanks, Divya, on the detailed overview on the freight market. Now let's move on to Expo specific information. Let's start off with the ocean freight segment. As we mentioned in the previous webinars, Expo has been employing a strategy to expand its ocean freight business with building relationships with liners and locking in favorable contractual and spot rates to enable efficient yield management. The ocean freight segment has increased its contribution to revenue, growing from a low base of 20% previously to 42% in FY22 to 62% in 1Q FY23. In FY22, Expo handled 281,000 TEUs, growing 49% year-on-year. In 1Q FY23 was an exceptional quarter where the company recorded 78,700 TEUs compared to 72,000 TEUs in 1Q FY22. This was achieved despite the slowdown in consumer demand in US, given the increase in interest rates. But with consumer demand slowing down even further with additional rate hikes in the US, we forecast a decline in trade volumes in the US trade lane as retailers have built up inventory. As a result, we do not expect a spike in demand for freight from retailers usually experienced during 2Q to materialize in 2Q FY23. With continued focus on ocean freight business, we expect this segment to contribute 67% of revenue during the second quarter, reflecting strong development of the ocean segment. We forecast ocean freight volumes in 2Q FY23 to be in line with 2Q FY22, where ocean freight volumes due to the slowdown on consumption in the US as discussed already. We expect Expo to outperform the general decline of volumes experienced by its peers due to adding new strategic customers to its portfolio and to some extent by its diversified origin presence. Even though there is a decline in volume in the US and Europe at present due to high interest rates, the Purchasing Managers Index in China is increasing, reflecting the expected increase in demand from the West over the next couple of quarters, which is expected to result in higher volumes in the second half of FY23 compared to 2Q FY23. By focusing on building on new relationships with liners and proactive yield management strategies with regards to contractual and spot rates, we expect the segmental GP margins to improve in the second quarter of FY23 to 18 to 19% in a declining freight rate environment. We expect retailers to replenish inventory after the built-up stock is sold during the Christmas holiday season. As a result, we expect the US import volume to increase in the third quarter FY23 and fourth quarter FY23. In such an environment, given Expo's addition of new strategic customers, there's a possibility of volumes and operating margins rebounding in the latter part of FY23. As explained in the previous slide, due to the shift in management strategy, growing its ocean freight business, the contribution to revenue from the air freight business declined. Although the air freight segment recorded 58% of revenue during FY22, it declined to 38% in 1Q FY23. This was due to the low demand for air freight across the market due to retailers building up inventory and retailers opting to use more cost-efficient ocean freight. In addition, growth experienced in the ocean freight business also added to the lower percentage contribution of the air freight business. As you can see in the graph, volumes grew 51% year-on-year, recording 198 million kilograms in FY22. But due to reasons already explained, volume declined by 22% year-on-year during 1Q FY23 to 32.9 million kilograms. In 2Q FY23, we expect air volume to face further decline due to the decline in consumer demand in an increasing interest rate environment. It is expected to result in decrease in air freight demand from retailers due to built-up inventory levels. But with the possibility of volumes rebounding in the latter part of 3Q FY23 and 4Q FY23, we forecast the air freight rates and volumes to pick up from the lows experienced in 2Q FY23. Similar to ocean freight segment, due to efficient yield management strategies, we expect the company to improve its GP margins in an environment where air freights are easing. We expect the gross profit margin for the air freight segment to increase to 12 to 13% in 2Q FY23. Having discussed the ocean and air freight segments, now let's move on to understanding the financial impact on the group in 2Q FY23. Let's start off with revenue. With the decline in volumes and freight rates, we forecast revenue declines in the 2Q FY23 as freight rates significantly decreased only at the end of 2Q FY23. Due to efficient dynamic procurement and yield management strategies, we expect GP margins to improve in 2Q FY23 in a declining rate environment. We expect GP margins to improve to 16.4% in the quarter. Due to decline in volumes experienced, we expect operating margins to decline to 8.5% due to lower absorption of fixed costs. As a result of all the points above, we expect Expo to achieve net profit attributable to equity holders close to the figure reported in 2Q FY22. With the decline in interest rates, air freights, and the freight rates, the PERs of freight forwarders have declined. As you can see in the exposed peers, such as Nagal, trades at PEs of 10.05 and based on FY23 earnings. Exposed peers that trade across multiple trade lanes are trading at an average of 16.65 times FY23 earnings. Expo, compared to its peers, is trading at a significant discount, where it trades at a PE of 4.98 times FY23 earnings. Having discussed our expectations for 2Q FY23, we have revised down our forecast for Expo given the sudden material change in the freight forwarding environment. We have accounted for the decline in freight rates as well as the decline in volumes. We have revised down our top line projections to FY23 to LKR 111.12 billion rupees. Given the decline in operating margins, we have forecasted EBIT margins of 9.84% for FY23 compared to 12.48% in FY22. We have forecasted a net profit to equity holders amounting to 65.01 billion in FY23, a 10.63% decline compared to FY22. Given the translation gains from the LKR depreciation, the PBV for the stock is forecasted at 1.68 times FY23 forecast. The company is trading at a very attractive PE of 4.98 times FY23 forecasted earnings, a significant discount to its peers. Given the decline in freight rates, it is expected that the company will be able to reduce its working capital requirements and deleverage its balance sheet, where the debt to equity is expected to decline from a 74.34% in FY22 to just 16.95% in FY23. However, there is a possibility the company might leverage again its balance sheet for higher yielding investments to ensure higher equity returns for the company. As mentioned before, the stock currently trades at a very attractive PE of 4.98 times FY23 forecast, given the revised forecasted earnings. With over 95% of its revenue in foreign currency, including 84% from the North American trade lane, the stock provides a natural hedge for investors against the LKR depreciation and provides investors protection against the economic turmoil faced by the Sri Lankan economy. In addition, given that only 5% of its revenue is from its local operations, the company is not expected to be impacted materially by the corporate tax rate increasing to 30% in Sri Lanka. As mentioned before, Expo is expected to outperform the market in terms of volume decline due to adding new strategic clients and increasing wallet shares. When the US retailer inventory levels require replenishing, possibly in 4Q FY23, as retailers place new orders, we forecast Expo's freight volumes and profitability rebound compared to 2Q FY23 forecasts. As stated in the previous webinars, we expect the stock to trade at a premium to the market PE due to its global presence, high liquidity, protection against economic challenges in Sri Lanka, and being attractive as a strategic acquisition target for global logistic operators. Considering the PE, peer average PE of 16.65 times forward earnings and the market PE of 5.24 times on a 50-50 basis, we expect the stock to trade at a PE of 10.95 times forecasted FY23 earnings, resulting in a fair value of 364 rupees, providing an upside of 119.61% from the current market price of 165.75. Given that Expo was trading at a significant discount to its regional peers, SG Holdings infused a total of 17 billion into the CSE to increase its stake in Expo by 3.85%, given the attractive value proposition of the share. During 2Q FY23, SG Holdings increased its stake in Expo from 75.62% as of 30th June 2022 to 79.47% as at 20th September 2022. SG Holdings purchased 75.34 million shares at an average price of rupees 226.77, purchasing the share up to LKR 235. SG Holdings acquiring 3.85% of the company at an average price of rupees 226.77 indicates that parent company is confident of the future performance of Expo and that is trading at a discount to its global peers. As mentioned before, Expo provides an integrated logistics service with a global network across 34 countries, offering a variety of services, including air and ocean freight, customs brokerage, 3PL and contract logistics services, overland transport, and related value-added supply chain services. Expo's global rankings ocean freight improved from 49th to 36th place over 2022 due to the expansion strategies implemented by management. In the air freight segment, Expo's rankings moved from 31 to 25 in 2022 in terms of the global air freight rankings. Given the impressive global rankings across ocean and air freight, global presence and portfolio of key strategic clients, it is the enterprise value of the company that is important to strategic investors, not the short-term quarterly earnings, which gets affected by the global recession and seasonality. Expo should be an attractive acquisition target for foreign freight forwarding companies due to its steep valuation discount, as Expo trades at a one-year forward PER of 4.98 times against a global peer average PER of 16.65 times earnings. Over to you, Prashani, now for the Q&A.
We thank you, Hasita, Divya, and the research division for their valuable insights. Now, Hasita and Divya will take up the questions sent to the chat.
Okay. Thanks, Prashani. We have got a few questions. Let me start with one of the most interesting ones. Why has the fair value reduced from 450 rupees to 364 rupees? Hasita, can you take this question?
Sure. So just to be clear, in terms of a valuation basis, we have maintained a valuation basis in terms of the multiples, where we take an average of the global peer multiples and the market multiples. So obviously, that's the same. The difference came through the forecasted earnings. So with regards to forecasted earnings, as we mentioned in the webinar, the US consumer demand has been changing, obviously very dynamic, especially with the rate hikes, etc. Interest rate hikes in the US. They've been very tough to predict. And going by even industry experts, for example, Nike, for example, they have built up inventory, which led to a cut down in importation volumes, the US. And even analysts in the US cut down the forecast for retailers only in mid-September. So we were relying on certain information coming from industry experts in terms of volume expectations for the future quarters. And now, since we have got more insight on that, in the second quarter, we have reduced the expectation on volume compared to previous forecasts, resulting in a lower earnings. But at the same time, what we have to keep in mind is, okay, there is built up inventory across different US retailers, which will be drawn down on in the third and fourth quarter before the Christmas sales or during the Christmas sales. So once that happens, there has to be replenishing of inventory most likely in the fourth quarter. So that ties in line with the manufacturing PMIs of China, for example, where the PMIs have been increasing for the last 3 months, the manufacturing PMIs. So that means, okay, there are orders coming in, but when that will be shipped out is the question mark. So there's expectations that might happen end of third quarter or in the fourth quarter of FY23, which should see a pickup in volume and obviously rates as well with the increasing demand. So we have accounted for that, and that has basically resulted in this fair value where the second quarter reduction in volumes and the reduction in earnings has led to a lower fair value.
Thanks, Aspen. So there's another question which reflects in terms of the freight rates actually. So the question has been asked, why was freight rates normalizing not accounted for in the forecast? Has this not been considered previously?
I'll take that question again. Yes, so basically we did account for normalizing of freight rates. So in our previous webinar as well. We have accounted for that in our FY23 forecast. But what really the difference did come through the volume reduction. We didn't forecast such a contraction in importation volume to the US. With the increase in rate hikes and the increase in built up inventory from retailers, that resulted in a volume reduction in the second quarter and possibly in the first half of the third quarter as well, before we see a pickup in the fourth quarter. So that was the key difference between our webinars, not the freight rates. Yes, we did expect freight rates to normalize, but volume decline is what really resulted in the decline in earnings.
Thanks, Asti. There's a question where someone has asked whether, don't you think the value of Expo as a company is lower now than before? I'll take that question. So when you look at a company like Expo, there are several things that we need to keep in mind. One is it is a global player with presence in over 34 countries. So to build to this level of scale, you can't only look at each sort of quarterly earnings or each financial year earnings in isolation. You need to look at something greater. You need to look at the enterprise value, because it takes a significant amount of time and effort in order to build this kind of business. So an enterprise value is a better reflection of the true value of the company. If you are looking at if you're taking a view of a long-term investor and you're looking at a long-term horizon. So in that aspect, the company has actually looked at and they have actually deleveraged their balance sheet, reduced their debt, which also helps in sort of increasing the enterprise value in the current environment. So we definitely do not think that the value of Expo has lowered. We actually believe that the value of Expo is enhanced.
Just adding to that, Divya, as Divya said, the company, so when at the moment where at the cycle where at the bottom of this cycle, most likely in terms of volume. So what the company is doing is adding to its key strategic clients portfolio, where when volume does pick up, they're in a prime position to pick up volume, increases volume far greater than the market increases, and also improve its profitability. So that value addition is there, which is not reflective in the current few quarters earnings.
Thanks, Asti. There's a question relating to SG's buying in the market. Will SG continue to buy in the market? So let me take that question. SG Holdings has infused about 17 billion rupees into the market and has bought approximately 75.3 million shares, increasing their stake by 3.85% to 79.47%. I think this was as at end of September. So their purchases have been ranging between 177 to 235 rupees over this period of time. So I mean, we do not have information in terms of SG's purchasing patterns, and we are not SG or the company, so we are unable to comment in terms of their buying in the market because we are not privy to that information. But what we need to keep in mind is the attractive valuation of Expo compared to its closest peers. Its peers at the moment are actually trading at 16.65 if you look at the average peer, while Expo is only trading at 4.98. So just in terms of the fundamental valuation of the company, it is very, very attractive compared to all other global peers. So keeping that in mind, it is attractive for any player to come in and look at a potential acquisition, given the current valuations. There's another question with regard to the earnings outlook. What is your outlook for the third quarter and the fourth quarter of financial year 23? Hasita, can you take this question?
Sure. As I mentioned before, we are currently at the bottom of the cycle in terms of volumes, both across ocean and air freight. But now, when the seasonal sales happen, there's expectation where the likes of Nike and other big retailers will go for flash sales to reduce their inventory levels before they're outdated. So when that happens, then basically there is going to be a replenishing of inventory. Yes, consumer demand has gone down, but if you look at the numbers, it has not gone down significantly in the US, for example. It's a 1.2% sort of decline in consumer spending. So this is the volume decline is mainly based on high inventory levels coming from retailers. So it's going to be a short cycle where until these inventory levels are drawn down and then get replenished, the volumes will be low across this the freight forwarding sector. So we expect things to pick up in the latter half of the third quarter and in the fourth quarter when this replenishing does start. And this is the reason for this is possibly the reason why even the manufacturing PMIs in China are increasing month on month, because manufacturing has actually gathered pace. It's just that the shipping of these goods will be dictated by the inventory levels of the retailers. So when the inventory does go down, there'll be a pickup in air freight and sea freight. So that will have a positive impact on export.
That's right. Just to add to that, in the first quarter, in order to even beat inflation, the retailers stocked up early and brought in goods early in the first quarter itself. So those inventory levels haven't gone down yet because consumer spending has to an extent got suppressed. But saying that for things like apparel, most of these retailers will not hold on to their stock. They will get rid of their stock over a period of time. And this is expected to happen roughly during the holiday season. So once inventory levels have been drawn down, then there would be a replenishment of goods, which we expect maybe towards the latter part of the third quarter to the fourth quarter of this year, where we expect again for cargo volumes to start picking up. There's another question in terms of earnings. Hasita, if you can take this, whether the earnings can be sustained at these current levels.
So as we mentioned before, the volumes will bottom out most likely in the second quarter. So even with that happening, the earnings will be still resilient compared to, it'll be in line with 2Q FY22. But with the increase in freight expected in the third and fourth quarter, and management continuing to increase their base in terms of key strategic clients and set itself up for future growth, we expect volumes and profitability to improve in the future quarters. So yes, the earnings is sustainable.
There's a question with regard to the strategies adopted by the group during these times. How is Expo able to be resilient during these tough times? So like we mentioned during our presentation, the management and the company has a long-term view, and that has been actually given them the solid foundation they need to grow and scale up their business. Even in times like this, they're constantly focusing on acquiring new clients, new strategic clients, deepening their wallet share and setting up the infrastructure so that when volumes pick up, they will naturally be able to capture sort of greater volumes. And sustain their growth. So they don't necessarily look at any short-term, strategic decisions. It's actually that they take a long-term view in terms of how to scale their business. And that has been the success of Expo, even unto this stage. There's another question, again, in terms of the earnings, but more relating to the cash flow. How is the cash flow position of the company at present, given the slowdown in the economy?
I'll take that question too. So basically, when freight rates come off or ease, that releases quite a bit of working capital when the receivables obtain or reduce. So that has happened so far from the peaks where working capital has eased, and obviously with that, the debt levels of the company also has reduced significantly. For example, debt to equity, which was around 74% in FY22, has now come down to around 16% in the first quarter. And with the further decreases in freight rates, that should even come off more. So that allows the company to actually explore other investment opportunities as well as acquisitions, where they can re-leverage off their balance sheet and look at various investments that will provide higher equity returns. So that is an opportunity for the company in the future, and possibly available instrument for them to increase returns.
Thanks, Asper. There's a question in terms of the taxes. How is the increase in corporate tax affecting Expo? Will this have a significant impact on their earnings?
Yeah, I'll take that again. So basically, the increase in taxes, this was something that we were expecting for some time. So if going back to a few of our previous webinars, we identified Expo as well as LOCB companies with big overseas presence, where the Sri Lankan revenue and profitability is not too significant compared to some of the overseas operations. So for example, for Expo, 95% of the revenue comes from overseas markets. So they pay taxes in those overseas markets. So increasing taxes from 14% to 30% for Expo in Sri Lanka will have a minimal impact. This is ignoring any tax losses they might have at a company level. So we don't see that being having any material impact on the company's profitability at present.
Thanks, Asper. There's a question with regard to the freight rates and volumes. When will freight rates and volumes increase? What is your expectation? So like we mentioned previously, we expect there to be a pickup in volumes once the inventory levels have fallen and the inventory levels of major retailers requires replenishing. So we expect this to come into play towards the end of the third quarter and early fourth quarter. So accordingly, we expect the volumes to increase during that period. There's another question with regard to the increase in personal taxes. How will the increase in personal taxes affect the fixed income and equities?
I can take that question, Divya. So basically, there are a couple of drastic changes into the personal income tax, how it affects the investors at present. So let's start off with fixed income. So at fixed income at the moment, there is a 5% withholding tax, which is not final on interest income, which is taken off at source. And rest of the interest income feeds into your personal income tax computation. So you're liable to pay tax on that. And now with these rates being charged at source, obviously the possibility of investors creating tax files, etc., is much higher because the authorities will have that information. So on the other hand, on equities, there is no capital gains tax, and the withholding tax of 15% on dividend income is final. So equities is more of a tax efficient instrument at the moment for investors compared to fixed income. So that's the main difference, and that might result in funds flowing from fixed income to equities because it being more efficient compared to previously. One thing to note is prior to 2019, there was withholding tax on fixed income, but that was final. So it didn't really feed into the your personal income tax computation. But now it's not final and it feeds into it. So that's the main difference. And that might be one reason why funds flow into equities in the near term.
There's one other question with regard to the consumer demand and its effect on Expo. How does the suppressed consumer demand affect in the US affect Expo's performance? So I think we may have touched upon this previously, but like we mentioned, the depressed, consumer spending is lower than expected as well. Even though there was a slight pickup witnessed in August, I think it was about 0.4%. Despite this, during this period of low consumer demand, overall the industry cargo volumes have recorded a decline. Like that, even Expo will most likely experience a decline as well. But given the sort of the strategies that they have adopted, they will be able to outperform the market, even in terms of a volume decline. Like we mentioned, the inventory is most likely to be drawn down by the end of the third quarter. And towards the end of the third quarter, we expect the retailers to replenish their inventory and for the cargo volumes to pick up at that point of time in time.
Are there any other questions?
In terms of, there is a question with regard to the fair values. Any reason why the share price did not come to the fair value that you had put in the last webinar? Essentially, like we mentioned, fair value is based on the fundamental value of the company. We have basically looked at the operating environment, the company's forecasted revenues, margins, volumes and rates, etc., and arrived at a forecasted earnings. And based on that, we have taken the peer valuations into consideration, as well as the Sri Lankan market PE multiples into consideration, and arrived at a fair value based on a weighted multiple. But saying that the fair value is only a reflection of the fundamental value of the company. Crowd behavior, takes the share price to the places that it is at the moment. So we are unable to, predict the investor behavior or their trading patterns. And that may be the reason as to why the share price does not necessarily reflect the fundamental value of the company. Since there's no more questions at the moment, we'd like to close the webinar. Over to you, Prashani.
Since there are no further questions, I would now like to close the webinar. On behalf of Capital Trust Research Private Limited, I wish to extend a sincere thank you for our valued clients for their participation and the staff who helped to organize this webinar. Hope to see you soon at our next webinar. Have a nice day.